What is going on, guys? It is the Zoomer Value Investor here to talk to you guys today about three big tech stocks in particular, really two and one to watch. That is going to be the two I really want to talk about are Amazon, Google, both of which I've been buying recently this week, and the one to watch would be Nvidia. So we're going to go and get into it. Now, these three stocks are what I would consider big tech stocks. Now, it's very up in the air, right? What is big tech? But what I tend to think of when it comes to big tech is you got to have obviously like triple digit billions in the valuation, over $100 billion. Like, um, I tend to think of like American big tech specifically. I talk about this a lot in this video, and this is still a very relevant video. I made this over a year ago, but it has to do with in the United States of America, the legal structure here in the United States. These big companies, they get certain teams of lawyers together. They find certain loopholes to establish like structural dominance in the market. And the U.S. does have things like antitrust and things of that nature, and they somewhat only slow down these companies. A lot of these companies are juggernauts for a reason, and a lot of things that get misconstrued about things like antitrust is if these companies get breaking apart, sometimes it's actually very good for the shareholder because a company like Google, for example, they could divest into Google Cloud, Google Search, Google AI, YouTube. All those become a separate business, and it can be valued by the market separately. So, a great example is you can look at GE. GE is a company that recently has spin off into several different sections, right? And for example, the section that makes like the consumer appliances of GE, it's not held to the same like lofty valuation that something like the GE Aerospace division would be. The Aerospace division, I believe, last I checked, was holding over a 40 price to earnings ratio. So that is the value creation if you think about it. Like GE would never, before it split off into all these different sub companies and it was all under one bloated company, it would never hold a valuation like that. So that's something to really consider. Is that when you're buying Amazon, when you're buying Google, or even Nvidia for that matter, I think a lot of people get caught up on buying a big tech stock and thinking about things like antitrust, but it doesn't work that way. A lot of things in the United States system kind of is there to keep shareholders wealthy in a way. I talked a lot about this a lot and how like wealth inequality and things like that. It just is written all over the United States capitalist system. So this is a very relevant video, definitely worth watching. But the thing that's really cool is that I would consider these stocks to be back in buy ranges. Now, when I was originally buying these stocks, if you were following on the channel, a lot of this buying was happening in like Q3, Q4 of 2022. That was like my pound the table kind of moment. I'm not quite there on these stocks right now, but what I do see is Amazon, I personally could consider around fair price right now. Google, I would consider around fair price right now. These high quality companies I've not seen around the fair price like about all of 2024. I've not been confident in buying these companies until recently again. And for me, these are, accumulation. I owned all these businesses back in late 2022. Obviously, they're much, much higher than when I bought them. And I think it's still time to keep buying. Um, it is nice to maybe keep that cost basis in your portfolio, right? It looks low. Makes the total gain percent looks very high that way. For example, like on Google, on my personal holdings, I believe I have it around like a $90 per share. So that would be roughly, about a 77, 78% gain or so. And it looks really cool to look at. It's nice to look at. But what you have to consider is just being the ability to just buy more shares today for a company with as good of a structural dominance, as good of assets as someone like Amazon or Google, I think is just an invaluable opportunity to call out. And the ability to just accumulate more in the long run, you're probably going to make more money that way. Because if you're just caught up with like, oh, I can't buy more because I bought some already and it was like way lower, and I just kind of want to wait to it to go like that low again. It might not never ever go that low again. Um, and this is something that a lot of people, especially like value investors, they can get burned by this. And I've been burned by this many times where you'll think a stock will go lower and maybe not. So Before Amazon goes to like, well above $200 again, before Google, breaks out, maybe Google goes above $200 again. Uh, this is almost inevitably going to happen in the future. And I don't want to miss it. I don't want to, I want to be able to have as many shares as I want to have. So I think these are a good time to accumulate these businesses. Now, Amazon dropped about 15% so far. Since this pullback we've seen here in late July. A lot of rocky markets. Obviously, the rate cut was announced. That is bullish for stocks. It has to do with the money market rate, and if the government money market rate is set at like 5% and like a 0.5% interest rate cut is announced, and likely more to follow, it's going to make stock assets look a lot more enticing, because if you have anywhere from like 8% to 10% is what you would expect from the S&P 500 return in a year. And there is risk. There's inherent risk in being involved in something like S&P 500 plus, excuse me, and stocks and things like that, compared to something like the money market, government money market, very secure, very almost guaranteed returns. Essentially, what happens is there's a lot of like higher up wealth managers and stuff. They have to allocate around that. So when the rate cut happens, it actually makes most stocks more attractive in that sense, because the risk reward just becomes better for stocks when the government money market rate is lower. And very interesting. So I think that is some fuel. Obviously, the election could make things uncertain. I'm a very big proponent of, it's 2024, it's election year. I think this is a good time to have like a 10% cash position. I don't want to like throw in a bunch of like fear, uncertainty, and doubt, because I think a lot of the stuff you see in the media is so overblown, guys. It's so overblown. As value investors, we got to really just be diligent about what's happening with the company, tune out pretty much all the noise with the media, guys. And but with that being said, though, sentiments do drive markets, and I wouldn't be too surprised if Amazon pulls back to even as low as like 150, possibly even maybe probably like 135. I would say. I don't think it'll go as low as like 120 or anything of that nature, but I'd say like 135 is on the table, especially if the broader market pulls back due to things like election fears and things of that nature. It's a very, very contentious political climate for sure. But like I said, tune out all the noise. Just focus on what your companies are doing. That's gonna. Peter Lynch talked about this a lot in his book One Up Wall Street. That a lot of people get thrown off by things like sentiment and stuff, and they try to outplay the market, and it just doesn't work. If you're focused on your companies, however, you're going to make a lot more rational decisions. Google pulled back about 15%. Very, very interesting. I do want to note that these two companies have very different strategies. For example, you're going to see a much lower PE ratio on Google than you will on Amazon. This has to do actually with a lot of things like capital expenditures. Amazon's more known to invest heavily in their business. I'll go ahead and just show you guys real quick, and then we'll return to the valuation slide. So as you can see here, these are like the most recent. Let's go to cash flow statement. It's gonna be a lot easier to show y'all on the cash flow. Like spending on operations and things like that nature for Google, it's not nearly as intensive, even though I don't mind seeing this 44 billion capital expenditures. That's not bad at all, because Google does need to start investing in themselves and things in AI. They can't really afford to fall behind, obviously. But when we look at Amazon, it's just going to be a whole different behemoth when it comes to things like investing in themselves, capital expenditures. So we go down here, right here. So about 60 billion in capital expenditures in the last 12 months, guys. That's serious money. That's not quite double what Google was spending, but probably like 1.5x what Google was spending about. Yeah, that's big money. So don't get spooked. I made a short about this, about Amazon. If you want to go on my shorts page, don't get spooked by this PE ratio so much on Amazon. It's another pitfall. Value investors, they learn like one thing about PE and they think it's like the end all be all of everything. It's really something. So Amazon, phenomenal company. It's like it's a modern megacorp, guys. And why they do so much capital expenditure, Jeff Bezos, it's the Jeff Bezos method. I don't think he likes to declare a lot of profits. When you declare a lot of profits, you actually have to pay a lot of tax. When you reinvest into the business, you're not necessarily paying tax on that because you're taking that inherent investor's risk. And, the IRS knows that. But the IRS also, wants to drive capitalism and stuff. So they allow megacorps to reinvest in themselves. So, but that's why Amazon could do things like that. That's why they started AWS in like 2009, and AWS is now the biggest cloud provider in the whole Western world, in the whole world essentially. Maybe in like China, things like Tencent Cloud or Alibaba are used more, but in the whole world, I mean, AWS has the most users. This is why Google could do things like Prime Video. This is why, This is why Amazon could do things like Prime Video. This is why Amazon could do things like spend cash acquisitions to buy Roomba, to buy Twitch. Ladies and gentlemen, this is all the dealings of a megacorp, and I don't think a conglomerate, a tech behemoth, at this price, before this thing rockets up to well above $200, it's only a matter of time. So I don't know how many more opportunities we're gonna get like this. And that's essentially all I wanted to say on Amazon. We're going to pivot over here. I'm going to give you all a last spiel on Google, and then we'll go over to the third stock of the video. So Google, obviously it's run different. They're a lot more sound. They actually declare a lot more profits than Amazon. But they still, I do like they've been stepping up their reinvestment in their business. Amazing assets, y'all. The one issue with Google, I would say, that Amazon doesn't have, that Google does have, even though Google might have more like stable assets, they're not, as everywhere as far as like investing in themselves. They have, a good balance sheet and things of that nature. One thing I will take away from Google is management is a little bit uncertain. I'm uncertain of Google's management, and I don't think they have I don't think they want to take over like the AI space. Like, I'm not getting the sense that they're super hungry for like going out there and just taking what's theirs. And I really would like to point y'all to this video. This is former CEO of Google, Eric Schmidt. I read his book called The Age of AI. And in this minute 30, he basically talks about compare Google to someone like OpenAI in 2019, 2020, before they made ChatGPT 3. So OpenAI, they're outworking Google. Like the average OpenAI employee is probably putting in 12-hour days, maybe closer to 14-hour days compared to the average Google employee at that time, 2019, 2020, was probably putting in their 8-hour day. And I talk about this a lot in my video here, where a company like Google, obviously they're going to have some of the best cloud professionals in the world. They're going to, on their payroll, they're going to have some of the best cybersecurity professionals, some of the best programmers. Like all those are going to be on Google's payroll. However, Google also does leaps and bounds to keep people very, very comfortable inside of Google. And a lot of the reasons why they do that is they know that on their payroll, they have some of the best developers. They have some of the best IT minds in the whole world on their payroll. And if those people were to leave their payroll, who knows? They go make their own business. They go make their own form of Google Cloud. They go make their own form of Google Search or Google Chatbot, the Gemini chatbot. So that's kind of Google's risk, is they almost need to have these people on this payroll and, give them good benefits, give them good, I don't know if you ever seen the videos of Google. They tons of free snacks. They have chefs at certain like Google campuses. They have laundry machines that are free, exercise rooms, all this stuff as to keep people very comfortable in their workplace, comfortable at their job. And then Google also will have clauses, right, where it's like, okay, if you want to work on a tech-related project, Google has to know about it, or you just can't do that. So there's a lot of those clauses in the work contracts and stuff, and that's the key. What people do know about tech and what they could contribute to like innovation or stuff, they contribute to Google instead of trying to build their own thing. And, if you're Google, you kind of have to do that. Like you want to stay entrenched, right? You want to stay on top. So it's a really, really interesting situation that Google finds themselves in, right? Now let's go ahead and switch over to valuation here. I'll do Google and then I'll do Amazon because I did forget to talk about Amazon's valuation. And this is, stock price. People pay way too much attention to the stock price. Number one, this means nothing that Google trades at 162. You actually want to look at, okay, what market cap am I buying Google from, right? Because if Google wanted to like do a stock split or something, then tomorrow a 10-to-1 stock split. Tomorrow I'm buying Google instead of 162 per share, I'm buying Google at $16.28 per share, right? So 10-to-1. So even though Google will still be a $2.01 trillion market cap company, like I could buy it hypothetically for a tenth of the stock price if they did a 10-to-1 split. So don't look at the stock price. It doesn't mean anything. It's such a common fallacy that people who honestly haven't read books about stocks and stuff just kind of espouse of like, oh, what's the stock price? Like, it doesn't matter. Yeah, so look at the market cap, and then obviously what we want to do is look at not just the PE ratio, but a larger picture of the valuation, right? So let's see what Google's got going on here. Valuation, and I pulled this back at about 5 years, and we can just kind of see like, what does Google tend to trade at? And they do tend to hover in this kind of like mid to high price to earnings here. And there's other metrics you can look at here, like price of sales, things of that nature. Definitely kind of give you like a decent idea. I really like to look at price over tangible book value per share. That's one of my favorite things to look at. And if we go over here, what I think is attractive is the forward earnings are some of the lowest they've ever been in years, not since like late 2022 when I was actually buying the stock. Like hand over fist, right? And actually pounding the table. I'm more into the, like I said about election uncertainties and stuff, have cash, but these stocks are very much, you're able to accumulate them in these ranges, I believe, at these prices or lower. Google at 165, Amazon at 170 or lower, very, very attractive. So as you see, forward earnings of 20, that's much lower than what this is tend to be over the course of the last few years. So Google with some like good guidance, push that forward earnings like pretty lower. And even the last 12 months, you're buying it at like a 23 when it tends to be around the mid 20s. So it's very viable, like very not. I don't think you're overpaying buying in these ranges. And the tangible book value per share has actually gone way up. I think this has to do with a lot of them paying down debt and things of that nature. They're becoming even more of like a lower debt company and gaining more assets. So phenomenal from Google. Gonna do the Amazon valuation really quickly, but thoroughly nonetheless. So we're gonna pull this back to about 5 years as far as we can. Sweet. Okay. So because again, like price to earnings is going to be very finicky with this company because of the Jeff Bezos model. They're continually reinvesting in themselves, but it's still the lowest it's ever been. I mean, forward of 33 on Amazon, that's unheard of. So I feel like this is the cheapest the company's ever been, while you're still getting this at quite a low. Like you're not overpaying on price of sales in either any of those investment metrics, and the tangible book value per share has gone up, probably due to them paying down debts and things of that nature. So very, very attractive stock for a lot of similar reasons. You can even rewind this to when I was last buying it. So like maybe September 30th, 2022, right? Is it that much different? Lower price of earnings. And then you can even just think about, right? Like, is Amazon structurally their dominance? Is it that much different? No, I tend to think it really isn't. So I still think it's an attractive buy if you have cash. And of course, the tangible book value per share has just gone up since then, even though the valuation metrics, both the price sales and price earnings, very similar. So yeah, incredibly attractive business. Certainly at these prices, just I think it'd be pretty hard to lose. You're buying shares. It's not like you're doing a sports betting. It's not like you're doing options trading. You're buying shares. You're buying an asset with no definite time of expiry in one of the best businesses in the world. So the last talk of the video here, NVIDIA. I would consider this recent rise in NVIDIA. NVIDIA, certainly I would consider American big tech at this point. They're actually the highest valuated company in the world after the run up. And I was buying this one in late 2022. However, I sold a lot, y'all, on this run. It's one of my biggest investment mistakes I believe I've ever made. And to put in perspective, in my personal portfolio, Nvidia is in there, and it's about like 0.75%. It's not even 1% of my holdings, y'all. If I held all of my original position, Nvidia would probably be about like 8 to 9% of my personal holding right now. If I just held it, never sold it, and that's a lot of wealth I lost out on. Even though I did get some wealth, I believe I sold around maybe like this wave here, sold again maybe here, and sold again here. And I, just with what I have left, it's really not much. But I think the structural dominance of Nvidia looks decent. I think there is no semiconductor designer quite like them. They're a fabless semiconductor company. What that means is, there's fab companies such as TSMC or Intel technically does fabs too, but don't buy Intel. Uh, fab fab semiconductor companies, I mean, they make the actual chip. They're actual semiconductor producers. Um, and fabs, those are the sites where they make those chips. Fabless companies are just designers. And the reason why these tend to be very separate companies, even though Intel does both, but Intel's kind of a dying company, is because the process of doing these is so intensive that you almost have to make separate companies just for designing and just for building. And when it comes to chip design, Nvidia's been ahead of the game for years, y'all, for years. And the market's really just now catching on. Market honestly pretty late to this, but I think why it's exploding so much is that GPUs become more important than ever with things like crypto mining, as well as just powering different computers and applications and things of that nature. A lot of computer applications become more and more processing power intensive. But not just that, data centers. Data center scaling up has led to NVIDIA for sure blowing up. And that's really kind of why I'm into this. So after hours, look at this, y'all. This crazy fall after hours. Let's see if we can pull up their earnings result here. I'm curious. Okay, on a revenue beat, so it probably was one of those things where Nvidia was priced so heavily that even if they could beat revenues, but I don't know if this doesn't seem accurate. Second quarter results. Okay, I'm assuming that this is the report that came out, but I don't. This is April, so maybe Google doesn't have the page I'm looking for up yet. So my apologies, y'all. But let's head into valuation here. Just kind of show y'all why maybe this company isn't super expensive. So even though the stock price has gone up so much, the company's making so much money to the point where they can justify like that higher stock price. So next 12 months earnings of 40, but when I was buying the stock in late 2022, it was the same. They're just making that much more money now on things like data centers, GPUs, and it's a tech race too, right? It's a tech arms race. So Meta is one of the biggest customers of Nvidia. So if Meta is buying a ton of Nvidia chips, technology wise, in terms of like processing power wise, and at Amazon's servers, in data centers, at Google's servers and data centers, they can't afford to fall behind on all that stuff, y'all. They want to be able to move at the speed that some of the best companies in the world, like Meta, are doing. Their peers in big tech. So that's that effect of arms race is, I think, another thing really playing into Nvidia's success. Now, this is one I'm a little more cautious towards adding to, and I have not added this one yet. I'm really looking for about $100 per share. Probably if it goes below 110, I wouldn't be surprised if I just go, I'm going to buy, a share or two. But, like, I'm really watching for closer to 100 to be like, okay, let's put some like serious skin into this one, maybe. But yeah, I think the structural dominance in the outlook of that looks pretty good for Nvidia. It's one I just don't want to ignore too much because you just got to tip your hat to them. They're the best at what they do, and there's a reason it's had the run it's had. It's really, I think the future, like I said, with things like data centers, GPUs, different applications that use GPUs, and as well as honestly crypto. Crypto is huge for like crypto mining in GPUs. That's another thing to consider. I think NVIDIA has just really shown that it's going to be the company of the future in a way. It is selling the picks and shovels of the future. If y'all have seen the movie Dune, the spice, that valuable resource in the movie Dune that is fought over, the spice, that kind of is what computer chips are like in the modern age, right? It's that valuable of a resource, like the best access to the best design chips, like that is the spice. That is that is some of the most valuable things we have here in the modern age, and that's why something like TMC is also, the actual fab company TMC, why they're going to be also immensely important, and why there is some geopolitical risk in for TMC SMC in the country they're located in, between the U.S. and China. But at the same time, they're the best at what they do, so can't ignore that either. And I do have a little bit of TMC in the personal holding, but not nearly as much as it's about as much as NVIDIA. It's really negligible. So with that being said, ladies and gentlemen, I hope this was a good video. Amazon, Google, I think are in amazing ranges right now. Too good to pass up. So thank you so much for watching. I'm the Zoomer Value Investor signing out. Peace.